All right, let's jump right into this explainer, because right now we are staring down a massive red flag in the economy. A quiet, downward revision of 57,000 jobs. Now, I know it's super easy to read a financial headline like that and just think, oh, well, that's just Wall Street noise. But it's not. Today, we're going to connect the dots between sweeping global economic shifts, starting with this exact jobs report panic, and the actual literal dollars and cents sitting in your bank account right now.
So it begs the question, do you feel like the financial landscape is just constantly shifting beneath your feet lately? You're definitely not alone. Behind the scenes, the fundamental rules of wealth, data, and asset valuation are literally being rewritten. We're going to connect some seemingly unrelated events today, from the Fed's absolute panic over missing jobs data, all the way to China hoarding physical gold, right down to your personal tax liabilities.
Okay, here's our agenda for today. 1. The Fed's new playbook. 2. The global gold pivot. 3. Bitcoin's brutal reality check. 4. The rise of AI advisors. And finally, number 5, the cost of leaving.
Kicking things off with Section 1, the Fed's new playbook.
So the Federal Reserve is finally waking up to the fact that their traditional data, it's basically just an echo of history. I mean, case in point, that massive downward revision of 57,000 jobs we just talked about. When employment data gets revised away months after the fact, the Fed is essentially flying blind. Because of this, they're actually launching what they call 5 task forces to completely review how they collect data, aiming to move toward real-time AI-driven sources. They're also ditching their traditional forward guidance. For everyday investors like us, less transparency from the Fed simply means the market is going to demand a much higher risk premium.
Which brings us to a huge question. Who really controls inflation data? Look, whoever picks the data picks the policy. If the Fed transitions to new metrics, maybe filtering out certain extreme variables, they can craft this perfect narrative that inflation and employment are totally under control. The counterargument, of course, is that this creates a smoother, more reliable economic picture. But the risk is that the Fed uses this to justify expanding liquidity, which is essentially printing money, without officially looking like they are.
Moving on to Section 2, the global gold pivot.
To really get this, we have to look at paper gold versus physical gold. You see, Western markets often run on paper gold. These are highly leveraged contracts where buyers never actually take delivery of the metal. It's basically a casino of speculation. Physical gold, on the other hand, is the actual tangible metal sitting in a vault. And right now, to hedge against things like those volatile U.S. jobs reports, global powers are demanding the real thing.
Just look at this number, 244. That's 244 tons. That is the sheer amount of physical gold that global central banks scooped up in just the first quarter of this year alone. It's a completely unprecedented, record-breaking pace. And get this, that number only includes officially reported purchases. If you factor in shadow accumulation, the real number is likely way, way higher. Central banks are aggressively dumping paper promises and hoarding real assets.
Let's look at how China is actually accelerating this pivot. Major Chinese banks have officially shut down retail paper gold trading for their citizens. Why would they do that? Well, to force real price discovery. They are basically building a parallel financial system. The Shanghai Gold Exchange is prioritizing actual physical delivery. And to support this whole operation, vault capacity in Hong Kong is expanding massively, going from 200 tons to a staggering 2,000 tons. Guys, this is a highly coordinated move to establish a real gold settlement hub entirely outside of the traditional Western system.
All right, Section 3, Bitcoin's brutal reality check. So Bitcoin recently suffered this massive drop of over 50% from its highs, and people definitely panicked. But mathematically speaking, this is actually entirely historically normal. Look at the timeline. In 2011, it dropped 99%. In 2013, 83%. 2018, 84%. Bitcoin operates on this almost robotic 4-year cycle of parabolic highs and brutal crashes. As painful as it feels in the moment, history shows us that this kind of wild volatility is literally baked right into the asset. Now check out this number, $53,000. In the crypto data world, this is known as the realized price. Think of it as the ultimate break-even point. It's the average price that the typical Bitcoin holder paid for their coins. Historically, whenever the market price falls briefly below this realized price, it marks complete investor capitulation. And it has reliably served as a rock-solid market floor right before a major reversal. So what exactly caused the sudden drop this time around? Well, large holders, the whales, have been dumping thousands of coins. And those heavily hyped ETFs? They're actually experiencing reverse liquidations. Plus, capital is rotating out of crypto and pouring straight into AI. Now, the counterargument here is that a crash like this simply flushes out the tourist investors, leaving a much stronger foundation behind. Still, the short-term reality is a broader loss of narrative conviction as traditional safe havens outpace digital ones.
Which leads us perfectly into Section 4, Rise of AI Advisors. Artificial intelligence is making a massive play for your wallet. Major tech companies are rolling out dedicated AI financial planning features left and right. And yeah, it is super impressive that AI models can score an 82.5% on benchmark finance tests. But we need to talk about that remaining 17.5%. That represents a very, very dangerous margin of error. In the world of complex finance, an AI hallucinating a tax law or just completely fabricating an investment fact, that can have catastrophic consequences for your life savings. So the crucial point here is weighing these pros and cons objectively. Yes, AI advisors offer incredible 24/7 accessibility, lightning-fast plan generation, and a judgment-free zone where you can be totally honest about your debts without feeling embarrassed. But the cons are severe. Beyond those hallucinations we just talked about, these tools completely lack a legal fiduciary duty. A registered human advisor is legally bound to put your best interest first. In AI, it's just a language prediction model giving you strings of text based on your prompts. There is absolute zero accountability if that advice totally ruins your portfolio. All right, let's look at Section 5, the cost of leaving. You might be thinking about moving abroad, but you can't just pack your bags and leave your tax liabilities behind. A lot of countries, including Canada and the US in different forms, utilize an exit tax. In Canada, it's known as a deemed disposition. Here's how it works. The moment you sever residential ties, the government treats your assets as if you sold them and then immediately bought them back the very day before you left. So even if you haven't actually sold a single stock or business share, you are instantly liable for all those unrealized capital gains. Let's walk step by step through how this actually hits a portfolio, using the Canadian model as our prime example. Step 1, you calculate the fair market value of your eligible assets. Step 2, determine your total unrealized capital gains. Step 3, apply the inclusion rate, which right now is 50% in Canada. Finally, Step 4, that amount is added to your regular income and taxed at your marginal rate. This can literally force people to liquidate their assets just to pay the tax bill.
But there is some nuance here. Take a look at this number, $1,275,000. That is the current lifetime capital gains exemption in Canada for qualified small business shares. This right here proves that strategic tax planning can legally shield over $1 million from the exit tax. While the rules are definitely strict, understanding the exact exemptions can absolutely save you a fortune.
All right, let's bring it all together with some actionable takeaways. Here is your personal playbook based on everything we've covered today. First, when economic indicators like those jobs reports are suddenly revised, expect market turbulence and ensure you have sufficient cash reserves on hand to weather the storm. Second, when volatile assets crash, utilize tax loss harvesting to offset your other capital gains. Third, go ahead and use AI to help you budget, but never, ever blindly trust it for comprehensive stock picks. And lastly, if you're planning an international move, consult a tax professional about exit taxes years in advance. The overarching theme of everything we talked about today is change. From the Fed struggling with massive jobs data revisions, to central banks hoarding gold, to AI completely changing retail advice, sitting still is just no longer an option. As global powers rewrite the rules of the new economy, how will you adjust your personal playbook to protect and grow your wealth? Thank you so much for joining me in this explainer, and I can't wait to explore our next topic together.